Good morning, students. In the last class, we have learned about the important functions of Reserve Bank of India. Reserve Bank of India is one of the important central government monetary institutions which can be controlled by the money market. Money market refers to lending and borrowing transaction with short-term funds. There are so important functions we have learned in the previous class: issuing currency notes, then bankers bank, margin requirements, credit control measures, qualitative control and quantitative controls. In the quantitative controls, CRR, SLR, open market operation, bank rate policy, then repo rate to reverse repo rate. Today we have discussed about the demand for money and supply of money. Let us take one by one. Demand for money. That one concept we have to a small introduction about that one. First to the introduction. Demand for money is the meaning. Demand for money is a derived demand for goods and services. Demand for money is a derived demand for goods and services in the economy. Demand for money arises due to demand for goods and services in the real economy. So, demand for money is gradually increases in the real society. That one valuable information must be entered that demand for money. Money can be used liquidity. I think that one effective word given by J.M. Keynes. Liquidity. Liquidity is nothing but a money. Demand for money. Liquidity, the term indicates demand for money. John Maynard Keynes wrote the one book, The General Theory of Employment, Interest and Money. It was published in the year of 1936. The General Theory of Employment, Interest and Money. Demand for money is a derived demand for goods and services in the real economy. Demand for money can be arises due to demand for goods and services in the economy. There is no demand for goods and services, that leads to there is no demand for money. According to John Maynard Keynes, demand for money can be arises from two motives. As per the NCERT textbook, there are two motives, but in the previous textbooks, world textbooks, there are three motives: transaction motive, precautionary motive, speculative motive. Demand for money arises from the three motives of the people in the real society. First one, transaction motive, precautionary motive, speculative motive. But there can be simplification and broadly classified into only two categories. Two motives of demand for money: transaction motive, another one speculative motive. Transaction motive, let us take one by one. Transaction motive, demand for money for transaction. Demand for money for transaction. Transaction motive means holding cash to meet daily expenditure. In the real society, people holding cash to meet daily expenditure, day-to-day expenditure. So demand for money for transaction motive, demand for money for transaction motive. In the society, number of people create demand for money for transaction motive. Transaction motive means holding cash to meet the daily expenditure, day-to-day expenditures. What are the day-to-day expenditures? purchase newspaper, milk, rice, dal, fruits, flowers, vegetables, day-to-day daily expenditure. Expenses must be clarification with the help of money. So, demand for money for fulfill the daily expenditure in the real society. Once again repeat, transaction motive, holding cash to meet daily expenditure of the people in the real society, day-to-day expenses. In the daily expenses, there are so many number of examples about the day-to-day expenditure that can be explained with the help of one equation or formula. m to the power of d, m to the power of d is equal to k into t, k point t. M is nothing but money, d is the demand, t is the transaction. And if you observe the equation, that one equation given by Professor John Maynard Keynes, m to the power of d, m to the power of d is equal to k t. M is the money, D is demand for money, T is the transaction motive, K indicates a positive fraction. Positive fractions are changes in the value of transaction. Changes in the value of transaction. Then T indicates a value of transaction. Total value of transaction. T indicates a total value of transaction. For example, per day, 400 rupees, 500 rupees daily expenditure. Demand for 400 rupees per day. Demand for 100 rupees per day. Demand for 300 rupees per day. That is a transaction motive. Demand for money. Demand for 300 rupees. For daily expenses, day-to-day expenditure, daily expenses. 300 rupees, demand for 300 rupees per day. That is a suitable example for transaction motive. Day-to-day daily expenditure created by the people in the real society that can be explained with the help of formula m to the power of d is equal to k t. T is the value of transaction, k is the positive fractions or changes in the value of transaction. Then velocity circulation flow of money. The velocity circulation flow of money. How can be? Day-to-day expenditure of money can be one hand to other hand. According to John Maynard Keynes, any one person expenditure is income of the other person. Any one person expenditure is income of the other person. The velocity circulation flow of money. The velocity circulation flow of money is gradually increases. The velocity circulation flow of money is gradually increases with the level of income. I think income and price is one of the two important indicators to increase the demand for money, increase the expenditure of the people in the real society, increase the expenditure of the people in the real society. The velocity circulation flow of money can be explained with the help of formula m to the power of d is equal to kty. Once again repeat, velocity circulation flow of money that can be the flow of money. How can be the real cash can be flow one hand to other hand. That means according to John Maynard Keynes, any one person expenditure is income of the other person. That can be explained m to the power of d is equal to kpy. Then k changes in the value of transaction. Then P is the general prices, then Y is the level of income. I think the level of income, general prices, the price of the goods and services decreases, the level of income of the people increases. Price of the, what is price? Price refers to monetary value of the goods and services. Suppose any price of the goods and services is gradually increases in the economy, that leads to level of income of the people increases. When the income of the people increases, that leads to demand for money increases. I think demand for money and level of income, a direct relationship between demand demand for money and level of income. The level of income increases. There are so many reasons. Level of income increases in the real society. That can be changes in the policies of the government. Then wages, salaries increases. Then price of the goods and services reduces. There are so many reasons or factors influence to increase the level of income of the people in the society. When the income of the people increases, that leads to demand for money increases. The velocity circulation flow of money is gradually increases. Velocity circulation flow of money gradually increases due to the level of price reduces and the income of the people increases. So these factors, price and level of income, these factors is creating effect on the velocity circulation flow of money in the real economy. Then the second motive, we move to observation. The second motive, students, if you observe the second motive, speculative motive. Speculative motive means speculators. Speculators who are working in the share market. Speculation. The term indicates when the price is less, that can be purchased, and sales when the price is increases. So that is a techniques used by the speculators. Speculative motive. Speculative motive is nothing but a speculative transaction created by the speculators. Demand for money. Demand for money arises from the speculation transaction. Speculative motive means when the price of product decreases, that can be purchased. When the price of product decreases, that can be purchased. That can be purchased and sales when the price is, suppose any price when the price of product decreases, that can be purchased. When the price reduces, when the price increases, that can be sales. I think buying and selling of share papers. Buying and selling of share papers with the variation in the share prices. Buying and selling of share papers with the variation in the share papers. Price of the share papers. Whatever it may be, any share papers or any whatever it may be, any products. So speculators, speculation. The process of speculation means when the share prices decreases, all the share papers purchased. When sales it price is high in the share market. I think you have to know that one. Simplification, that one. Meaning of the speculation, the process of speculation. When the price of the share papers reduces, sales, then purchases increases. In other way, any price of the share papers increases, sales increases. So that one process, speculation process, can be created by the speculators in the share market. The speculation process can be created by the speculators in the share market. So those speculators can be create a demand for money. Demand for money arises. Demand for money is a derived demand. Demand for speculation transaction, speculative motive. Once again repeat, demand for money is a derived demand. Demand for money is a derived demand. Demand for speculative motive. Demand for speculative motive. Demand for speculation process. Speculative process. Demand for speculative process. Demand for share papers. Demand for share papers. You have to observation, when the share prices reduces, all the share papers must be purchased by the speculators when they are selling the with the price high rate. When the price is high rate in the share market, all the share papers must be sold and differentiate amount will become a profit to the speculators. I think you have to observation one formula, m to the power of d is equivalent to r maximum minus r divided by r minus r minimum. R maximum is nothing but the rate of interest. The speculative motive is mainly depends on rate of interest, and demand for money is a derived demand. Demand for speculative motive. Demand for speculation process. Speculation process means buying and selling of share papers. Buying and selling of share papers in the share market when the price variation. Ms to the power of d. D is the demand for money. S is the speculation. R is the maximum rate of interest. Then minus R is the rate of interest. Divided by R is rate of interest. Minus R minimum rate of interest. That can be explained with the help of diagram formula. I think speculative motive and rate of interest, you have to clarification, differentiate between the speculative motive and rate of interest. Speculative motive, rate of interest. When the rate of interest is more, rate of interest increases, so speculative demand for money. Speculative demand for money reduces. Speculative demand for money reduces. In other way, any rate of interest reduces, speculative demand for money increases. Inverse relationship between rate of interest and speculative demand for money. Inverse relationship between rate of interest and speculative demand for money. I think rate of interest is a liquidity. I think sacrifices. The liquidity sacrifices at a certain period of time. Rate of interest is the returns. Rate of interest is an returns. Liquidity sacrifices at a certain period of time. Rate of interest is increases at the time speculative demand for money reduces. In other way, any rate of interest reduces, speculative demand for money increases. Inverse relationship between speculative demand for money and rate of interest. Then that can be, you have to observation with the help of diagram. You have to observe the diagram. OX axis indicates demand for speculative demand for money. OX axis indicates speculative demand for money. OY axis indicates rate of interest. OY axis indicates rate of interest. Then that one line indicates liquidity. I think that one line indicates is a rectangular hyperbola. That one shape of the line rectangular hyperbola. Liquidity line as a demand for line. Demand for money line. That one point indicates liquidity gap. Liquidity gap. We have the observation OM1 speculative demand for money. OM1 speculative demand for money. Then rate of interest is maximum. When the rate of interest is maximum, you have the observation how much. If you give that one PQ. OM1 speculative demand for money. You have to write that one OM1 speculative demand for money. Then OP is the rate of interest. Rate of interest. OP indicates the rate of interest. When the rate of interest is OP, OM1 speculative demand for money. You have the observation the quantity of speculative demand for money OM1. OP is greater than OM1. OP OM1. That means the speculative demand for money is very less than that of percentage of rate of interest. Rate of interest is maximum. Rate of interest is maximum at the time. The speculative demand for money is OM1. That will be shown in the diagram. When the rate of interest is gradually decreases, rate of interest is gradually decreases to P to Q point. Rate of interest is gradually decreases P point to Q point. The speculative demand for money increases. Speculative demand for money increases OM1 to OM2. Speculative demand for money increases OM1 to OM2. We have the clarification in the diagram. The speculative demand for money is increases OM1 to OM2 due to rate of interest. Rate of interest is gradually decreases maximum to minimum. In the Q point, we have the observation Q point to maximum to minimum, the rate of interest. In this one point, OM2 speculative demand for money, OM2 percentage speculative demand for money, then OQ is the rate of interest, OQ rate of interest, OM2 speculative demand for money at OQ rate of interest, OM2 speculative demand for money, OM2 speculative demand for money at OQ rate of interest, at OQ rate of interest. That can be clarification. When the rate of interest is more, speculative demand for money is decreases. In other way, any rate of interest is increases, speculative demand for money reduces. I think inverse relationship between the rate of interest and speculative demand for money. Rate of interest and the speculative demand for money. That can be clarification. When the rate of interest is gradually decreases at a point of time, the rate of interest cannot be decreases 0.2 onwards. Rate of interest cannot be decreases 0.2 onwards due to the financial institutions incur in loss. Due to financial institution incur in loss. That one stage is called liquidity trap. That one stage is called liquidity trap. The rate of interest cannot be increases at a certain stage. Rate of interest cannot be decreases at a certain stage. So the financial institutions must be incurred in loss. That one point indicates a liquidity trap. In this liquidity trap, the rate of interest cannot be decreases and the demand for money cannot be increases. Rate of interest cannot be decreases and demand for money cannot be increases, and the share prices expectations of the speculators, suppose any share prices reduces in the further days, that type of situation is called liquidity trap. Liquidity trap means rate of interest fallen to a certain level. Rate of interest fallen to a certain level. Any that one point onwards, any rate of interest reduces, cannot be reduced. Suppose any reduces, that can be incur loss to the financial institutions. Then you in the entire diagram you can clarification. The liquidity trap. The liquidity is a demand for money. According to John Maynard Keynes, explain the liquidity is nothing but a demand for money. The rate of interest, liquidity rate of interest means it is a sacrifices at a particular point of time, at a certain period of time. A sacrifices of money. It is a returns. Those interest rate is the returns sacrifices. Those interest rate is an returns of the sacrifices, liquidity, sacrifices of money. Liquidity are sacrifices of money. That can be clarification. The infinite, the rate cannot be. That is an interest line. We have the observation. Rectangular hyperbola line indicates the interest line. It is the infinity that the line cannot be reduces. against to the OX axis. Against to the OX axis. That can be clarification. There are two motives. Demand for money, the transaction motive, speculative motive. I think transaction motive, John Mills can be called it M1, and the speculative motive indicates or denoted in the form of M2. Once again repeat, transaction motive can be denoted in the form of M1 and speculative motive can be denoted in the form of M2. Okay friends? Students, we have observed in the previous videos two motives of demand for money. There are speculative motive, transaction motive, precautionary motive. Unexpected situations arises in the real economy. Unexpected situations, health, education, then accident, whatever any unexpected situation arises. Precautionary motive. Precautionary motive. Demand for precaution. Demand for precaution. Demand for money, demand for transaction motive, demand for money for transaction motive, demand for money for speculative motive. Then aggregate demand for money. Aggregate demand for money can be clear with the help of one equation. Aggregate demand for money. Aggregate demand for money. M is equivalent to MDT plus m to the power m to the power of d. That one equation indicates aggregate demand for money. Aggregate demand for money. Once again repeat, aggregate demand for money. Aggregate demand for money is equivalent to MT. T is the transaction motive. M to the power of d is the demand for money. T is the transaction plus M. S is the speculative motive, then m to the power of t is the demand for money. Demand for money is the speculative motive. Demand for money is the demand for speculative. Demand for money is the demand for transaction motive. M is equivalent to m t, m to the power of d plus m s, m to the power of d. The velocity circulation flow of money when one person expenditure is income of T. The velocity circulation flow of money that can be indicates any one person expenditure. Any one person expenditure is an income of T. Is an income of T. Income of the other person. Students, observe the next concept. The supply of money with various measures. First, for the meaning. Supply of money refers to stock of money, existence in economy in the form of currency notes and coins. Stock of money held by the public and banks and bank deposits, held by the public and bank deposits in the form of currency notes and coins. In the form of currency notes and coins, it is entirely called stock. Supply of money. Supply of money refers to stock of money which is held by the public and bank deposits in the form of currency notes and coins. How much quantity of money supplied by the Reserve Bank of India and commercial banks in the form of currency, real currency notes and coins. How much currency notes and coins availability in the public as well as in the bank deposits. Then second one, main suppliers of money. The main suppliers of money in the entire Indian economy, there are two important institutions. One is Reserve Bank of India. Reserve Bank of India issue currency notes with the help of printing machine and provide loans and advances to the commercial banks against rediscounting of bills. Then otherwise, commercial banks increase the supply of money in the form of credit creation. Commercial banks provide loans and advances to the public against rate of interest. Commercial banks increase the supply of money against rate of interest. Reserve Bank of India increase the supply of money issuing new currency notes to the public and provide loans and advances to the commercial banks against rediscounting of bills. The main suppliers of money, Reserve Bank of India and commercial bank. Then deposits in commercial banks. I think deposit mobilization. Deposit mobilization is one of the important function of the commercial banks. Without deposits, no one commercial banks cannot provide loans and advances to the public. There are two types of deposits: demand deposits and time deposits. Demand deposits means they are payable by the bank on demand from the account holder. Demand from the account holder. Demand deposit. Demand deposit is a derived demand amount deposited in the banks in the form of SB account, saving bank account, then otherwise current account, saving bank account to current account. So these are a suitable example for demand deposits. Demand deposits, those deposits payable by the bank on demand from the account holder. For example, SB account to current account. And time deposits. Time deposits refers to those deposits which can be based on the time, a particular time period. For example, recurring deposits, fixed deposits. Recurring deposits, fixed deposits. Those deposits which can be matured on the date of time. For example, 1 year, 2 years, 3 years, 5 years, 10 years, on the basis of the convenience of the customer with the banker. The recurring deposits, fixed deposits, the time deposits. The deposits, the process of deposits is very essential to commercial banks provide loans and advances to the public. Then currency notes and coins. The currency notes and coins issued by the Reserve Bank of India with the help of printing machine and provide loans and advances to the commercial banks. Then commercial banks is also provide currency notes and coins in the form of loans and advances to the people in the real society. The currency notes like 5 rupees, 10 rupees, 20, 50 rupees, 100, then 200 rupees, then otherwise 500, 2000 rupee currency notes. They are really existence in the economy. Fiat money. Fiat money is also called legal tender money. Fiat money means how much quantity of money existence in the public in the form of currency notes and coins. Currency notes and coins are called fiat money. Currency notes and coins. Currency notes and coins are the fiat money. Then legal tender money. Legal tender money refers to, you know, the recurring or variable memory power. What is money? Money refers to medium of exchange, measure of value, store of value, transfer of value accepted by people and government is called money. That can be accepted by the central government. That money is called legal tender money. I think the rules and regulations of the central government must be prescribed on the currency notes. Then otherwise, legal definition of money supply. Legal definition of money supply. Supply of money. Legal definition of broadly classified into two categories: narrow money, broad money. Narrow money is more liquidity. I think more liquid. Narrow money refers to those money is more liquid, easy circulation flow in the economy. For example, real currency notes and coins that can be denoted M1 plus M2. M1 plus M2, including it is called narrow money, is more liquidity, easy, more circulation. The velocity circulation flow of money is more in the economy. Then otherwise broad money. Broad money is a less liquidity. Broad money means less liquidity. That can be denoted in the form of M3 plus M4. Broad money is less liquidity. That can be denoted in the form of M3, M4. Shares, debentures, equities, check, then treasury bill, bill of exchange, valuable papers. I think we have to know the example. What is the difference between the narrow money and broad money? 2000 rupees check is a suitable example for broad money. Then 2000 rupee currency note is narrow money. I think 2000 rupee currency note is more liquidity than that of 2000 rupee currency, 2000 rupees check. 2000 rupee check is less liquidity than that of 2000 rupee currency note. We have one 2000 rupee currency note, easily expenditure. We have to expenses in the real market, but the check, 2000 rupee check cannot be easily circulation in the economy. Then M1, M2, M3, M4. The legal definition must be prescribed by the Reserve Bank of India. M1, M2, M3, M4. M1 is equivalent to CP plus DD. M1 is equivalent to CP plus DD. CP indicates currency held by the public. Currency held by the public. How much quantity of currency notes and coins existence in the public, that can be shown in the form of CP. Then DD. Demand deposits in the commercial banks. Demand deposits in the commercial banks, that can be shown in the form of DD. M1 is equivalent to CP plus DD. Demand deposits, they are payable by the bank on demand from the account holder, SBI account to current account to demand deposits. That can be create demand from the account holder against the banker. Then M2 is equivalent to M1 plus POSBD. M2 is equivalent to M1 plus POSBD. POSBD is nothing but a post office saving bank deposits. Post office saving bank deposits. Post office saving bank deposits, that can be shown in the form of POSBD. M2 is equivalent to M1 plus POSBD. Then M3 is equivalent to M1 plus net time deposits. This namely refers to at a particular point period of time. That what time deposits must be involved at a certain period of time. Recurring deposits to fixed deposits. Suitable example for time deposits. M1 is equivalent to net time deposits. Net is nothing but the tax reduction in the demand deposits and recurring deposits. Then M4 is equivalent to M3 plus total deposits plus post office saving organizations. M4 is equivalent to M3 plus total deposits plus post office saving organization, excluding national savings certificate, because that one national savings certificate is already including the savings of the government. Excluding national savings certificate. Then M1, once again repeat that one equation. M1 is equivalent to CP plus BD. M2 is equivalent to M1 plus POSBD. Then M3 is equivalent to M1 plus net time deposits of the commercial banks. M4 is equivalent to M3 plus total deposits plus post office saving organization, excluding national savings certificate. So these are all the supply of money, various measures of supply of money. You know that one, what is the relationship between the supply of money and demand for money? Suppose any supply of money is greater than demand for money in the economy, that leads to create inflation. Inflation refers to level of general prices increases, as a result purchasing power of money reduces. In other way, any demand for money is greater than supply of money, then it's becoming deflation. Demand for money is greater than supply of money, then it's becoming deflation. Means level of general prices decreases. Level of general prices decreases, the value of money or purchasing power of money increases. Value of money or purchasing power of money increases. The price of the goods and services gradually decreases in the real society. What is price? Price refers to monetary value of the goods and services. Suppose any price of the goods and services is gradually decreases in the economy, that leads to increase the value of money or purchasing power of money. Value of money or purchasing power of money increases. So the equilibrium between the demand for money and supply of money and control the inflation deflation by the Reserve Bank of India. Reserve Bank of India effective utilization two instruments, quantitative instruments, then qualitative instruments. Quantitative instruments, CRR, cash reserve ratio, statutory liquidity ratio, open market operation, bank rate policy. Then the four effective instruments utilization by the Reserve Bank of India to control inflation. Then qualitative instruments, direct action, moral motivation, margin requirements. There are three important factors or conditions must be preparation by the Reserve Bank of India on commercial banks. Then another one, last concept in this one chapter, demonetization. I will explain in the next class. The demonetization is one of the important indicators for project oriented question 5 marks. Okay students, whatever any doubts regarding that one concept, please send the message on individual WhatsApp number. Thank you.